So the next kind of indicator we're going to go over next are momentum indicators. Before that, let's talk a bit about market momentum. So market momentum refers to how fast a market or an asset will continue to increase or decrease in price over a period of time. We can think of this as the rate of change, how fast and how quickly it's increasing, or how fast or quickly it's decreasing. Market momentum can be considered to be what creates a overall market trend and also is a reflection of current market sentiment. If things are very bullish, if market sentiment is very bullish, the market in theory should quickly increase and slowly decrease. So when there are dips, it should be slower compared to when market momentum is bearish, where the downsides will be faster compared to any relief rallies. Market momentum factors in trading volume as well, where periods of high volume indicate stronger market trends and thus reinforcing the momentum of the market in whichever direction it's moving. Now here's a basic momentum indicator. This is something that I don't personally use. There's other momentum indicators that I have found to be more beneficial, and I think for the most part, people don't really use basic momentum indicators. There are other kinds of indicators that we're going to use and we're going to go over, but this just gives a general description or visualization of market momentum. So this is the S&P 500. This is traditional equity, a broad index, if you will. And the same concept applies here as it does to crypto when you're looking at Bitcoin or Ethereum or really any other asset. The same fundamentals of how we're using the concept of momentum indicators and realizing that, hey, momentum is going down. At the same time, the market was tanking, right? This is in 2020, March 2020, early 2020. So this was a clear visualization shown not only in price, but also in overall market momentum. Market momentum reached an extreme low that really hasn't been reached, at least, I mean, this chart goes back to 2012. We have not seen such a severe dip in market momentum, and even before this, whereas in price, we do see that price was at this level, at least for the S&P 500 at 2250. We saw some sort of bottoming out. The market price was at this area back in 2017. So this is 3 years of gains essentially erased in maybe a week or two. Now, in terms of market momentum, this was an extreme low value, and this could have been seen as, well, this is some sort of bottom. Well, market momentum reached such an extreme low, and then there was a very swift springboard back, as we could see in the indicator. Right, we went from extreme low to very quickly, and maybe in the course of like a month or two, back to an extreme high of maybe below this 800, this negative 800 figure, to a high of this 800 positive figure. At the same time, we didn't really quite see a swing back even to the highs that were observed right before the crash in 2020. This is something to keep in mind and to look at when we're observing, momentum, and these indicators, especially oscillators, they're portraying price change, not so much the actual price itself. So there are a few types of momentum indicators. They measure the rate of increase or decrease in an asset's price. Some examples of commonly used momentum indicators include the relative strength index, or the RSI, and also the moving average convergence divergence, the MACD, which we discussed in our previous lesson. Today we're going to talk about the RSI. So RSI indicators provide traders an alternate way of viewing the market. It's an oscillator. We know that it's on a fixed scale between 0 to 100 or 0 to 1, depending on how it's set, and it measures the momentum of price movement, how fast or slow price is changing. The RSI calculates changes in the asset's price over 14 periods. This will be 14 days on a daily chart, 14 hours on a 1 hour chart. If you're looking at 30-minute chart, it's going to consider the past 14 candles. So each one of those being 30 minutes. So you could do the math on that. I'm not going to do that right now. So that's something to consider. It will vary and change based on which chart you're looking at. Now, the RSI tracks price change over 14 periods by default. This can be changed in the settings. Most people keep it on that 14 period price period. Usually it's a typical thing in trading. Note, though, that RSI is based on fewer periods, such as the 7 period, will be much more sensitive to price movements and fluctuations because it's looking at a smaller sample size, as opposed to RSI is tracking more periods. And on the other end of this, we could look at something like the 21-day RSI, which will be much slower to react to possible price fluctuations and trend shifts, right? So 14 is typically kind of right in the middle. Some people play around with this. I have personally found success with the 14, and I find that it's a nice sweet spot. But feel free to experiment and find what works best for you. Now, the RSI uses a formula that divides the average price increase over the 14 periods by the average price decrease. This data is then plotted onto a scale from 0 to 100 and is displayed as an oscillator. The RSI rises as the amount and the size of green candle closes increase, and it falls as the amount and size of red candle closes increase. So it'll fluctuate based on what the market is doing. Here's an example of the RSI. This is on the Bitcoin US dollar, the daily chart, particularly from 2020 to about late 2021. Here is our RSI, and here are our values, as you can see, from 100 being the extreme high and 0 being the extreme low. And as the market would fluctuate, we do see fluctuations in the RSI, indicating general price momentum and trend shifts in buying and purchasing flow, and how that is resulting on the price chart itself. So let's talk about overbought and oversold RSI conditions. So we saw previously on the bottom scale that the RSI gauges the price of an asset on a scale from 0 to 100 based on the previous 14 periods. Now, within that, an RSI score of 30 or lower indicates that the asset is oversold. Now, an RSI score of 70 or higher indicates that the asset is overbought. It's important to note that these quotations, as we saw above, are used because they are condition labels, not necessarily that the asset is actually overbought or oversold. It's just a condition that indicators will label certain assets. If the RSI is the reading is below 30 on a certain asset, it's considered oversold in terms of indicator reading, not necessarily that, oh, that's the bottom. Just because an asset is oversold doesn't mean that it can't still fall more. Price can still fall more if oversold, and price can still increase if overbought. Now, these settings can be changed. Traders can opt to change the overbought or oversold levels to different values instead of 30 or 70. The 80 level, some people switch to 80 and 20, where the 80 level becomes an overbought level in bull markets and the 20 level an oversold level in bear markets. This is something that some people do, so this is something that you may want to experiment with. If you're new to trading, if you're new to the RSI, I would suggest just sticking with 30 and 70, and then maybe saying, well, it looks like relying on the 30 for certain readings and certain patterns may be more beneficial compared to the more default settings. That's up to you. Now, Another thing to consider, short-term traders may favor the 20 or 80 oversold or overbought values when using different techniques on reading the RSI to provide less false signals. And we'll talk about different strategies and ways to utilize the RSI for trade signals in the coming slides. So here's an example of an RSI. And here are different levels. So here's our RSI, our overbought level at 70, and our oversold level at the bottom at 30. Now on a chart, on a price chart, here is Link on the 2-hour chart. And here we see just this overall fluctuation. Every one of these bars represents 2 hours worth of price data. And here we see the fluctuations in terms of market momentum as shown in the RSI. Several instances, as we can see, breaching this top line, which is our overbought level, which is at 70. So here we see multiple instances, prices coming up. And in these cases, price actually did come up. What's interesting here, price came back down for a little bit. The momentum indicator came down, but price continued to go up a little bit more, right? So it's not always, oh, it's overbought, that means it's going to come down. Even in this situation, we saw the RSI come up right around here and then start to decline where Link continued to climb. So that did not necessarily signal a top or a market top. Just because the condition was signaled as overbought does not mean that the asset price will not continue to rise. And we see the same thing as price is going down as well. Here we see price returning from this oversold level, and it does continue to fall as well. There's many more examples of this that we can find in other assets as well.